Hey, you had some good questions with our conversation the other day about routing your student loans through your policy first, your life insurance policies. And so I went back and looked at some more material, and this is hopefully give you some more ideas to wrap your head around it, why it's important to do it. Um, you know, what I have screenshots of here comes from the book Building Your Warehouse of Wealth from Nelson Nash. Um, he also touched on it in his first book, Becoming Your Own Banker, in describing the infinite banking concept. The overall idea of anticipating the windfall is that wealth has to reside someplace. You either keep it in your own private family bank, your own policy network, or you're turning it over to the bank down the street, which they receive the profits for, or you turn it over to Wall Street where they control it and it's completely out of your control. So in other words, we just want to find a way to properly structure these policies so that it will accept large amounts of money in the future. And this is what we're trying to get you started with. The idea of the windfall came from England back in the for the last 1,000 years or whatever. The King of England owned all of the oak trees. Oak is the best lumber, I guess, available for his ships, and so nobody could cut down an oak tree. But if the wind were to blow it over, then the peasant could use the lumber himself. So that became the windfall. Well, nowadays, since we're not peasants, we have different concepts of windfalls. Our big tax refunds, if you're managing it that way. If you sell your home or other property, you have to have a place for your extra equity. You might get a job severance. That's common. For people to get several $1,000s that can quickly get squandered. Inheritances, for instance. And you have to watch that job severance because you may run out and buy a camper or something like that. And businesses may have particularly good quarter or year or sell a division or a property. And so you need to have a warehouse for that wealth, a place to put it that is safe and doesn't keep it at, it grows, but doesn't put it at risk, put your capital at risk. He talks about, in this book and in this section of the book about he created a life insurance policy for himself that he really, took out maximum loans on for 13 years because he owed a bunch of money to the banks, and banks were charging interest rates in the upper teens, near 20%. And he found that if he took out if he created these oversized life insurance policies, then he could pull down, take a policy loan and then pay off the bank. And the effect of it is move the loan over to the insurance company. And that way he controlled it. And that's the big part of it. There's a lot of financial peace there too, because, if you have these loans outstanding, the insurance company merely, pays out a net death benefit. So whenever you see it on the statement, it's net of any loans. It's easy to keep track of. The other key part of this is that when you're creating these larger policies by running your debt payment through the policy, the effect of it is that you are buying life insurance at a young age and then paying for it when you're older and you have more earnings or after the kids leave the house and you have more net income available. And that's what he talks about here in this section, where you may have a 6-year-old daughter now, but in 16 years, the daughter will hopefully leave the house and not be a boomerang and come back. Um, and then what you're used to spending on the upkeep of that dependent child, all of a sudden you have available. And so you need to have a place to store that wealth in a way that, um, like I say, is safe. Otherwise, it has a cost to it, so that you don't do something frivolous with all that extra money, like running out to eat all the time, just because the kids aren't home. And that's something that empty nesting parents run into a lot. Um, we'll get you that book here, but I just kind of scrolling through it. Um, the Here's an example here where his mother-in-law was in a nursing home and was costing $5,000 a month in the nursing home. Well, when mother dies, then all of a sudden you have extra income available, and so you have to have, and that's an example of a windfall, where you have extra money available that you had gotten used to spending. And that's what we refer to as Parkinson's law, where you have a necessity, where you're spending money on a necessity, and then all of a sudden you get used to it over the years, and so when it works both directions. So we're used to hearing it in terms of like the teacher assigns a paper that's due in 5 days, and everybody waits to the fourth day to start it, right? The time it takes to complete a task expands to fill the time allotted. But the corollary there is that once you have a luxury, such as heated seats in your car, once you enjoy it, it becomes a necessity, and you get used to good things. You get used to spending patterns without realizing that it's really costing you. How many people do you hear about that? They just get used to their cable bill, and all of a sudden it's $130. Well, where the heck did that come from, right? So when you get used to having a student loan payment, what do you suppose will happen, 6 years from now when you pay it all off? Okay, what happens to that cash flow? Are you going to carefully guard that cash flow, or are you going to run out? Oh gosh, we have an extra $500 a month to spend on something else, fancy pants and lollipops and shiny things. We have to remember that money, your earnings, your capital, it has a cost. Not necessarily a percentage cost, but the effort and the trouble and the toil and the work that it takes to earn money. And so you need to create the storage space for your money that respects the extra capital when you have it available, whether it's in the form of expenses that are no longer there, or windfalls such as inheritances or big gifts from family and that type of thing. So I just wanted to give you some examples and kind of rearrange our thinking here. Think long term, think a decade, 2 decades ahead. What will things be like? How much would you be earning as a household? Who will be working? What will you be doing? That type of thing. You don't know, and that's why we create these safety nets with the flexible, life insurance policies. When you pay when you make your paid up additional premium, your PUA premium payment first, and then take a policy loan out, and then pay the student loan with that cash flow, you're capturing it in effect. And but if you just write a check to the loan, of course, to the student loan, you're never going to see that money again. So at least you have you're creating a warehouse where that cash that you earned always stays with you. But the other thing is, your life insurance policy is not like a car loan or a mortgage. When you send the car finance company the $500 check, they don't write back and say, well, let us know if you want to borrow $500 again. It's guaranteed, no credit check. Same thing with a credit card. or home equity line, they make, call that a revolving loan. But, we found that 10 years ago with the Great Recession that, banks pull back. And so when just when you need the money the most, the bank is not there for you. But life insurance is completely different. They're contractually obligated to make those policy loans available. And the best part is those loans, the policy values, the collateral, continues to rise. It's guaranteed to rise, unlike your car or your mortgage. And of course, it wouldn't be fun without all sorts of examples. But so I did kind of a before and after. I ran some policy illustrations showing what it's like, what are the cash flows like if you created a policy that was just a straight life insurance policy versus capturing those student loan payments with the policy. And it surprised me. It's fascinating. So here we're jump starting a policy, we're capitalizing our system, but then the next 6 years, we're paying $500 a month for 6 years, and the effective is because it doesn't cost us any extra in the policy. I have zeros there. By running it through the policy first, we're not spending any extra out of pocket. And then we're postponing paying the loans here for the future. So now we have this policy loan available, say $36,000 or $40,000 balance, whatever it is, sitting in the policy. And so we make those payments. We're postponing here. We're continuing to make these payments later. And the beauty is, you control the policy loans. You decide when to pay them, especially in later years when your household income is higher and not just starting out fresh out of college. The beauty of it here is too, you control these, so you can do $500 a month, you can do $200 a month, you can do whatever you want. You can pay interest only, whatever you want. You still want to pay them back at some point, but they're flexible. If you don't want to pay anything on any given month, you don't have to. And what I found is the big difference comes down at the end here, where the difference between the cash you had available in 40 years with paying, processing your student loans first or without, you end up with $200,000 extra of cash value just by paying. You said, well, I don't want to pay these student loans twice. Well, here you paid, what, 2, 4, 6, 8. You paid nearly $50,000, and that was worth $200,000. Okay, so the effect of it is really you got a 4% return on your money, completely tax-free, income tax-free, with no risk, and it just, it's it's just enormously powerful. So hope this is helpful. It's enormously confusing because this is just a one-way conversation, but I hope this, I may have said a thing or two that piques your interest and makes sense for you. The big key here is over these years of having the oversized life insurance policy. Let's see if I can do this in a few seconds here. If you go to age 50, 25 years into the policy, without running student loans through your system, you have a death benefit of $387. But when you do run them through the policy, it's $757. So you have a almost a $400,000 increase in debt.